folks, Scott here. This is the wrap for Wednesday, July 17th. Very interesting and somewhat unusual day today. We had an unfilled up gap, as evidenced by the lowest low on this 5-minute chart, never trading at or below this blue line, which is the prior day's close. Now, that's not that unusual. What's unusual is that we didn't make any headway to the upside. We had a real narrow range day and an unfilled up gap. Even inclusive of the true range, this is just a narrow day. So what I thought, there's a bunch of things in play, by the way, that just to point them out, that'll be covered by our worksheet for members. Today was a false down day, right? We closed up with a red candlestick. On the daily futures chart, we had a higher high and a higher close, but we closed below the open. That's unusual. Tomorrow's Thursday of OPEX week. We've got 3 days in a row where the high of the past 3 days are within 1 point of one another. So that'll be something I want to look at tomorrow. If we get a big gap up, the highs of the past 3 days have all been very close. In general, historically, that's resulted in some pressure to the upside if we do gap up. Now, with that said, this particular study actually favors shorting an up gap. And what I'm going to show you are the results of fading gaps after an unfilled up gap and a narrow range day. I've defined it as today's range being less than 75% of the 5-day ATR. So I'm using the cash index, the day's range being less than 75% of the 5-day average. Well, there you go. So it's about 50-50 in terms of which way we're likely to gap tomorrow based upon this particular study. However, an up gap and a down gap both look attractive using an end-of-day stop. Now, I don't recommend you use an end-of-day stop, but it's a good place to start your analysis. And it does show it's been way more profitable shorting up gaps because using an end-of-the-day stop, the average loss has been less. Half of what the longs have shown. So it's more likely to run to the downside if you get a gap down that doesn't fill. Well, that's a small sample size, though. But it sort of makes sense, right? If you have an unfilled up gap, yet it can't get any momentum after the open to the upside, maybe it's running into some headwinds that'll still be present on a subsequent up gap. Anyhow, there's some food for thought. All right, let's show you the worksheet for today. This was posted last night, like it is every night, around 6 p.m. Eastern Time. And the markets, let's see, we gapped up in mixed zones. We were either in just inside of the prior highs or even above, I believe, in the NASDAQ this morning. A gap up actually had really strong profitability. See the PF 1.6? That means it's made 60% more profits than losses. This is our worksheet is an average of all 8 gap guides. Gapping up between the high and the close is more of a neutral setup, but it's really, you got to break it down more and look at the individual gap guides. I'll tell you what, I'm not going to do that because most of them were still in the zone that I call the DOC zone, and pretty much this was pretty normal, just a neutral setup. So nothing to get too excited about there, nothing too terrible either. So I'm sort of, when I see numbers like this, I'm undecided. In terms of unique day factors, these are things that are not considered by the gap guides. Today was Wednesday of options expiration week. During a bullish market, historical up gaps have been problematic. Just tends to be a bullish day for some reason. Let's see, other unique patterns. Bearish outside day, just neutral to slightly attractive. Up gap after a widespread 7. That's the widest day of the past 7. Has been positive. So here's how the other analysis I looked at and how I summed it all up. Per last night's wrap, fading up gaps after the prior session closed a prior day unfilled up gap. Pretty unusual. Only a 50-50 trade for an up gap. So that was also working against us today. And then we had a large gap size, and at least in terms of measured as a percentage of the 5-day ATR, which is a great way to measure volatility and relative size of gaps. After a large gap after a lower close went above the 10 and 200-day moving average. Not a great win rate, but profitability is okay. But when you break it down by whether or not we open inside the prior day high or above it, that makes all the difference. So inside the prior day's range makes it much more problematic. If it rallies so much you open above the prior highs, and this is counterintuitive, it's been very profitable. And I even ran a time optimization show that 10 a.m. had a 70% win rate. So some folks did report to me that they use this nugget here to get short at the open. I did not, because overall it just wasn't quite compelling enough for me. Mixed factors overall, mostly neutral setups. And had we gapped above the highs, I'd been pretty aggressively looking for a short opportunity after the open, but we did not. So I said I would wait for the range guides. I did, and let me show you my 5-minute charts. This is the S&P 500 5-minute candlesticks. You can see this is the Nasdaq down here, Russell up here. Russell never quite filled. The low of the day never got to the blue line, which is the prior day's close. The Nasdaq did late in the session around 3 o'clock. The Dow did, and the ES did not. The white line is where we opened. So we took some heat, and had you closed it around 10 o'clock, you'd have gotten pretty much the whole move of the day, most of it. But again, I did not take it, left it alone. The 15-minute range guides came out. They were slightly attractive. So what I do when they're slightly attractive and I had some gap probabilities that were favorable, like today, I will wait for confirmation. So I let it break down, make sure it was more than 2 points below the open, and then I shorted a test back up to this pink line or purple line, the low of the 15-minute range. I used a tighter stop because I knew if we got new highs, it would probably continue higher. That was my thinking. And I got stopped down, lost 3 points on that spike right there. It was really disappointing because the rest of the day the market traded below it. I'm trying to remember what. I don't think there was anything other than a short covering spike. I don't think there was any news or anything. A little bit of rotten luck there, but the rotten luck continued when the first hour guides came out. They're based upon trading around these yellow lines. Those are the ranges. That's the high and low range of the first hour. Favored the high breakout slightly as well. So I traded at quarter size. I posted in the trading room, only quarter size in the Russell, and I'd wait for more confirmation from the ES. ES had some confluence of, actually a lot of confluence, a lot of potential resistance here. Russell looked like a better setup to me. The advanced studies confirmed it. Went long. Let's see, what was the high today? 1045.30. Oh, good. I didn't catch the exact high. I only missed it by a tick, though. Went long, got filled at 1045.20, and lost 24 correction. My stop was set for 24 ticks, and I had 2 ticks of slippage, so I lost $260 per contract. A little surprising, quite frankly. It also tells you we're running as resistance. This move right here, this has been a power move all year. Near gap fill, reversal, continue high. It's been easy money in the high breakout. It just, I knew there was risk. That's the good news. So only lost on a quarter size trade, but still it stunk. So 2 back-to-back decent probability trades, decent expectancy trades was enough for me to call it a day. Just nothing there. Market's too choppy. Called it right. Didn't miss a thing the rest of the day. And that was my tough day. So hope your day was better. If not, tomorrow's another day. Use good money management, and we'll see you tomorrow. Take care.